Canada's housing crisis isn't just about affordability anymore. It's about structural failure. Over the past 5 years, we've watched the market defy gravity, driven by low inventory, inflated demand, and a financial system that quietly encouraged people to treat their homes like limitless ATMs. This series will explore what really happened, who's benefiting, and what comes next. In early 2022, the average Canadian home peaked at just over $816,000 in value. That was during a frenzy of post-pandemic buying, low interest rates, and massive fiscal stimulus. But fast forward to Q1 of 2025, and average prices have barely fallen, now sitting around $719,000. That's only a 12% decline, despite interest rates tripling and household debt hitting historic highs. In Toronto and Vancouver, prices dipped and then rebounded again thanks to chronic underbuilding and investor speculation. Even as sales slowed, the floor prices have remained stubbornly high. The idea that prices would crash once interest rate rose, it just didn't happen. During the housing boom, Canadians borrowed heavily against rising home equity. Between 2021 and 2024, home equity line of credit, HELOC, balances jumped 25%. Now that prices have fallen, many are stuck with high interest debt tied to less valuable homes. HELOC delinquencies are rising too. 1% of balances were 90 plus days overdue in Q1 of 2025. Some people used HELOCs to help their kids buy homes or just to stay afloat, but those debts haven't disappeared. And for many, they've become a trap. But there's a catch. Home values aren't what they used to be. And now the equity people borrowed against is eroding. For many, it means they can't refinance. They're stuck paying rising interest on shrinking equity. And the house they thought would fund retirement is now just debt. For older homeowners, tapping into home equity seems smart. But if the market softens, that wealth becomes harder to realize, especially with those who use it to support adult children, cover rising living costs, or delay downsizing. Here's what most Canadians still don't know. The Bank of Canada controls the overnight rate, which influences variable mortgages. But fixed rates, those come from bond markets. 5-year fixed mortgages move with the Government of Canada 5-year bond yields. And those yields have stayed high, not just because of inflation, but because Canada is running large structural deficits. Investors who buy those bonds demand more return to lend to a government that keeps spending as their investment policy. So even though the Bank of Canada has cut rates to 2.75, fixed mortgage rates remain elevated because the 5-year bond yields are still high. Variable rates, meanwhile, are tied to the Bank of Canada. But banks are shrinking their discount off prime. So while the Bank of Canada is at 2.75, prime is at 4.75. So that is how the banks make money off of variable mortgages. And then they'll discount. Right now, it's a discount of 0.2% or less, compared to in the late 2000s when you could easily find negative 1% off prime. Home ownership in Canada is stable on paper, but 75% of those over 65 and 44% of those under 35 being owners. But what that hides is a growing split. Younger Canadians need help. 1 in 3 under 35 homeowners receive family assistance. Those without help are stuck renting, often indefinitely. Many of these homeowners saw explosive gains in home equity, but that's trapped on paper only wealth. To access it, they'd have to sell. And where would they go? Older Canadians are also stuck, just in a different way. Many used HELOCs to help their children buy homes and now can't afford to downsize. They're tied to homes with rising maintenance costs and dwindling options. The condo market isn't helping anyone. We spent years building micro units for investors, not live-in owners. Now the few larger, downsize-friendly, family-friendly condos are scarce, expensive per square foot, and saddled with rising condo fees because they're older. Families want those units now, pushing prices even higher. For many older Canadians, downsizing just doesn't make sense. Seniors who could once downsize to a manageable home are now staying put, not out of preference, but because the math doesn't work. Without seniors downsizing, we miss a large segment of housing available for move-up buyers. Canada's immigration surge since 2020 added pressure to housing, but not in the way that headlines suggest. Most newcomers rent, not buy. They didn't drive bidding wars. Investors did. Canada increased immigration targets. Speculators, big and small, snapped up homes, expecting rental demand to surge and never end. Many converted homes into high-density rentals or rooming houses. That activity drove up home prices on the expectation of rising rental income, not real housing need. So, did immigration move up home prices? Not directly, but it created the conditions that allowed speculation to flourish and pushed even more Canadians out of the market. The reason both parties were so unwilling to put hard caps on immigration right now isn't altruistic. It's because of who their donors are: developers and big landlords. This is how we got here, with a housing ladder jammed up at every rung. But where are we sitting today, and where are we going? In part 2, we're going to look at where we are with foreclosures, vendor take-back mortgages, predicted job losses by economists, and how banks are quietly changing the rules for who gets to keep their home. If you think we've hit the worst of it, part 2 will change your mind. Subscribe now. It drops next Friday.